Hello again and good Thursday afternoon. Welcome back to Finom Group's weekly State of the Market. I am your host, Seth Golden. It's been a long time. I shouldn't have left you without a dope. No, we're not going to do any of it. No, okay. All right, folks. Well, here we are again. It's been a couple of weeks. I've been under the weather, had some scheduling conflicts, but we're right back at it with our weekly State of the Market. Hope this one finds everybody in good spirits, and let's get right to it. Inflation, right? We've heard a lot about that. We're going to continue to hear a lot about that, especially next week, because we're going to be getting the PPI and CPI data next week, Producer Price Index and Consumer Price Index. I think we got consumer prices next week. I know we got producer prices. With that being said, I like to, kick things off with some just some thoughts that, pop into my head and some just really good investing and trading disciplines. Some of them are colloquialisms. Some of those are just truisms in general. This one here, top of my list here, some 90% of RIAs, and for those of you not familiar with that acronym, it's Registered Investment Advisors. Some 90% of RIAs can't analyze markets with any proficiency. Some 90% of analysts can't advise clients in a manner that achieves even market performance. What does this basically mean? Quite frankly, it's easier to talk markets than it is to invest and trade markets. We see these folks marched out all the time. Bloomberg, Fox Business News, CNBC, they got YouTube videos here, there, everywhere, Twitter profiles, you name it. And they're always talking a good game. But the reality is that's the easy part, especially when you're not invested or you're just in a passive, maybe, portfolio because you can't invest because there's conflicts of interest with the firm you represent. So it's just really easy to talk about markets, suggest this chart, and the technicals tell me this. The market cycle tells me that. Again, the easy part is talking markets. The hard part is investing. And this is especially true when it's your own capital. Remember this, the next time you hear a talking head tout a surge or even a correction ahead, follow those who show they perform, not just talk a good game and post good charts. And don't get me wrong, the information that they share on these financial media or social media outlets, I'm not saying it's useless. I'm not saying it's, they're moot points or what have you. But in general, it takes more than talking to deliver returns. And if you don't have any vested interest, how can you really be fearful or, ebullient about markets, overjoyed about, the trend? You've got to have a stake in the game. This tweet here by Kaylee Cox of Ally Financial just the other day. Building wealth is so much more about managing your emotions and insecurities than picking the right investments. I totally agree. It really does lend itself well to, everything that I've mentioned up here. Building wealth is so much more about managing your emotions and insecurities than picking the right investments. Don't get me wrong. In my opinion, it helps to pick the right stocks, ETFs, or, trend and identify these fundamentals and those technicals. But when it comes down to it, you've got to be able to manage your emotions. When things go against you, you can't be so quick to hit that sell button. When things are going in your favor, you got to be careful about over leveraging because you like the price action and forgetting to take some profits, paying yourself for that good pick, that good trade, that good analysis that went into that trade or investment idea. My response to Kaylee was, so true. You got to manage your emotions. I would simply add, invest in what you know, and to the degree you can dedicate time to following the fundamentals. When we trade and invest in what we do know, in what we don't know, when we trade and invest what we don't know, we tend to react to price predicated on those emotional triggers caused by the price action. You got a tip from a friend. He likes XYZ stock. You buy XYZ stock, it goes against you. You know nothing about it. Now you're more likely to sell because you can know nothing about it and you're starting to lose capital, taking a drawdown. That's why I say it's always better to invest in what you know. This way you're limiting those emotional triggers. Friend of mine, Chris Dover, has a good one here. He tweeted out just the other day. This is the best way to exploit my investing trading edge. Have the long-term economics planned out. You got a good idea of the whole macro picture. Review that model daily. Has anything changed for the better, for the worse? Spend 15 minutes implementing what you've reviewed. Visualize the outcomes of your trades and or investments. Spend a lot of time not doing anything related to trading and investing. Look, you can get this tunnel of vision. You can be very, create kind of an echo chamber. The more time you spend on your investments and trading, you got to have kind of a balance. You've heard of work-life balance. Well, portfolio management life balance. It's got to be there. It's got to be there. And read a lot of long-term thinking books. Key is long-term. He says that twice in his bullet points here. Have the long-term economics planned out. Read a lot of long-term thinking books. Again, this also helps you to avoid those emotional triggers within your trading and investing regiment or processes. Where are we in the S&P 500? Well, let's first look at the sectors. I mean, we're just off the all-time highs by 1% or so. A little bit of a pullback in the markets this week. We've gone nowhere now this will be the fourth week that we've essentially gone nowhere. 4 weeks ago on a Friday, we closed at 41.85. 2 weeks ago on a Friday, we closed at 41.80. Last week, we closed on a Friday at 41.81. This week, we're right around that level still. This goes to, point out the fact that consolidation doesn't just happen in one way. Most people think of consolidation as a correction. It happens in terms of price. Not true. You can consolidate for both price and time. They don't have to happen together. Right now, we're doing a lot of time consolidation as we go through earnings season. We're winning again, folks. Got my hat on, Yankees. It wasn't a good start to the year, but we've started to pick up the pace. Stanton hitting a few home runs. Last 3-4 games, Judge hitting some home runs. I'm sure y'all care, just if you were wondering. So anyways, we're looking at the sectors here. All the S&P 500 sectors are trading above their 50-day moving average. But you'll notice on the screen here, we have some that are going in one direction, in terms of their overbought conditions here, going closer to their 50-day moving average. And then we have others that are moving further away from their 50-day moving average, like energy. We've heard a lot of bullish commentary on the energy sector. Fundstrat Tom Lee says you got to be in the energy sector. That one has been performing. Another one, materials, financials, industrials. What is that thematic of? Well, cyclicals, value, the reopening, right? Those are what has been in favor. We look at the worst performing on a relative basis, and top of the list, getting that much closer to the 50-day moving average, may even be there as of today. Technology sector, right? We've seen once again, technology, the NASDAQ, large cap growth, FanMag, all come under pressure since about last Thursday, and after the NASDAQ hit a new all-time high. It was not a meaningful all-time high. It dropped right, from the opening bell last week once it hit that all-time high. So we've got that whole cohort of non-reopening stocks and sectors that have come under pressure, including consumer discretionary. I would caution against, in terms of, looking at consumer discretionary in the same vein as technology, mainly because 3 stocks in the consumer discretionary sector make up some 50+% of that ETF. And we're talking about Tesla, Amazon, and Home Depot, not in that order. Amazon is first, Tesla second, Home Depot's third. So that one, you got to look at the equal weight consumer discretionary ETF to get a true sense of, what consumer discretionary stocks are doing. All right, well, again, everything's over its 50-day moving average, but we've got some trending more favorably than others in terms of sector ETFs within the S&P. All right, this table right here, this is one of our breadth studies. This is the percent of S&P 500 stocks trading above their 200-day moving average. Even with some of the selling pressure here this week, we still have more than 90%, 91% of S&P 500 stocks trading above their 200-day moving average. Why is this key? Why do we continue to come back to this? Because today, I believe, will mark day 46 in a row where we actually have more than 80% above their 200-day moving average, which kicked off basically back here in, I think it was March 8th or March 9th. So this will be the 46th day in a row. We have more than 80% of S&P 500 stocks trading above their 200-day moving average. Again, why is that so relevant? Because if it happens, it's going to kick off this breadth signal. If we get to 61 days, it's basically 2 weeks away now, 61 consecutive days of greater than 80% of S&P 500 stocks above their 200-day moving average. It happened in February of this year already. 1 month later returns, 2 months later, 3, 6, 9, 1 year. Now, 1 month later, we were actually down, but we made up for it 2 months later. So this was the first time actually that for this particular criterion, this breadth study, that we failed to achieve the 1 month forward returns after this breadth signal fires. But 2 months later, we certainly did. And we're in May now. This will be 3 months later. We've actually already achieved this. We've already, returned more than 4.4% 3 months later. This will be, May 5th. We've already done this. 6 months later, market's supposed to be up 6.2. We've done this. 9 months later, 1 year later. So what this basically tells us, we may have pulled forward, but if we get the breadth signal to fire yet again, have we ever done that in 1 calendar year? No, we haven't. We've never had this particular breadth signal fire twice in 1 calendar year. And it could happen here in this month at this pace, unless we see greater price consolidation across the S&P 500. The issue when you get breadth signals like this is it usually coincides with a meaningful upthrust, new trend, if you will, in the market, like 1995, like 2003, like, of course, 2009, after the great financial crisis. In 2003, that was the new bull market as well, the new cyclical bull market coming after basically a 2-year downturn that followed both the dot-com crash and 9/11 and a recession in 2001. It wasn't until March of 2003, for those of you who know your market history, bombs over Baghdad, right? March 2003, that's when the market started flying. And it didn't stop until basically late 2007, 2008. So all of these coincide with basically a new, market cycle uptrend. Coming out of the European debt crisis in March 2011, right? And here we are. But we don't have two happening in the same calendar year. Like, seriously, you want to short this market? If that happens, come on. And the reason why I think we still are maintaining such a high level here is because what we're really seeing is rotations in the market, just constant rotations. We just talked about the sectors, right? In March, through March, it was all about technology, large cap growth, fan mag. Now those are out of favor again, and everything else is coming back. The bottom of this chart is coming back. So it's hard to get, all of these stocks to start moving down and to see the whole market move down in unison. It's really tough to do. That's a message that the market has been constantly delivering. You've got to know your breath. You've got to know your history. All right, well, what else might happen this year? And we've talked about this in the past briefly. The S&P 500 rarely posts 3 consecutive years of double-digit returns, and this is an important observation now. We're already up 11% in 2021. The S&P 500 was up 31.2% and 18% in 2019 and 2020. So that's 2 consecutive years. This would be a third if it happens. Since 1958, the S&P only went on to produce a positive double-digit return for a third straight year or more during 3 periods: 1963 to 65, 1995 to 99, and 2012 to 2014. Folks, when I look at all the different studies that we have, whether it's not, getting back to the December low, that's a particular breadth study, that's a historic piece of data, in the next year during the first quarter, if you don't revisit the prior year's December low, you usually have a nice double-digit return for that following calendar year this year. The average second year of a new bull market also tends to deliver a double-digit return. So far, both of those qualify. The Valentine's Day breadth signal, if you're up 4% or greater into and through Valentine's Day, the rest of the year is up double digits. The Toy Barometer, turn of the year, that's the acronym, TOY, turn of the year barometer, basically measures November 19 to January 19 of the following year. If you're up 3% or greater, it's a bullish signal. The average return is double digits. On average, I think it's 16 to 17%. Folks, we've nailed all of those. And we're already up 11%. We could see a lot of choppiness between now and the end of the year, but all signs point to this being the 4th time the S&P 500 will deliver 3 consecutive years of double-digit returns. Nothing's guaranteed, but that's the way the breadth signals and historic data are set up at the moment. All right, since 1950, the S&P 500, we're in the whole sell in May and go away period, right? Which basically is the end of April through the end of October. Since 1950, the S&P 500 has risen an average of only 1.5% from the end of April to the end of October. It's the worst 6 months of the year. Sometimes it's just the way you look at a chart, or different charts lend themselves better to just kind of understanding the principles or the dynamics around the seasonal factors at play. The S&P 500 just posted its best start to a year since 2003. But things are changing quickly, and investors are starting to get a little anxious, especially with markets not even correcting 5% in the last 6 months on a closing basis. We've had a 5.8% drawdown here this year, but not on a closing basis. We had a massive outside reversal day that got us back, within less than a 5% drawdown on the closing basis. That was in late February into the first week of March. We usually see about 5% drawdowns on average a year. That data goes back to 1980. It's typical for the S&P 500 to go through at least one 10% drop in its recovery after a big bear market also. This chart right here basically shows you, those declines. The averaged annual decline is about 14.3, 14.4% on any given year. That data also goes back to 1980. Does it mean you have to get a 14% drawdown? No, it's an average. Some years you get an 18% drawdown. Some years you get a 3% drawdown. But it's the average going back to 1980 in terms of double-digit drawdowns a year. So if you're investing for the next few years, basically don't let a few speed bumps shake you out of the market. Summer drops can be buying opportunities. They don't always break markets, folks. Think about the macro picture. Think long term. All right, this chart right here talks about volatility. Volatility has run down really fast here in 2021. 2020, of course, was a period of truly outsized volatility with 110 days that we had 1% gain, 1% daily volatility. Getting plus 100, 1% days has only happened 7 times since 1958. 2021 has been much quieter so far. Through the first 4 months, we're annualizing a run rate of about 66 1% days versus the long run average of 54. So we are still above the average. So that may sound like 2020 is still running pretty choppy, but keep in mind that usually year 2 after a plus 100, 1% year 1 sees Q1 volatility run an average of 27 1% days. Q1 in 2021 had only 18 1% days. Again, just kind of depicting that volatility has actually tempered down rather quickly compared to previous years that we've had these 100 plus 1% days. As you can see here, the threshold on the chart. All right, now here's another series of data for the S&P 500. This is going back to 1990. It's every May calendar year going back to 1990 and how it performed. 1990 was a good one. Up 9%. Was that the biggest? Yep, that was the biggest. The worst was 2010, which is where we are now. And we know what that we know where that lines up with. It lines up perfectly with the 2010 analog that we've been following since, May of last year. Yeah, May of last year actually is when we started highlighting the S&P 500 2009 analog, where we hit the bottom in 2009 was March. We hit the bottom of the market in March of 2020, and the analog lined up perfectly. We are right now in this period of the 2010 to 2021 analog where the S&P 500 in May of 2010 took about a 16% correction. We'll keep it in mind. History doesn't always repeat, but it does have a way of rhyming very well. There's some other analogs that may prove relevant as well. And these are some of them, folks, because this particular start to 2021 looks a lot like 2018, looks a lot like 2012, looks a lot like 1998, speaking of the NASDAQ, although I'm not. This is the S&P 500. And here, 1997. We can go back nearly 100 years and look for every 4-month start to the year. But these are the 4 that showed up from the sentiment trader as being the most aligned. And most of them, here you go, are starting to get into that 100-day period where you get this choppy downward price action before the next leg of the rally. Choppy downward price action, next leg of the rally. Choppy sideways, slightly lower price action, next leg of the rally. 2012, and that was another double-digit return year, was the only one that you didn't see it show up until about the 120th day. So keep these in mind as well. So we've mentioned the NASDAQ, we mentioned large cap growth, we've mentioned technology. The narrative, if you go back to February, when you speaking of that area of or those areas of the market, growth, large cap, FanMag, NASDAQ, was that when yields are rising, when rates are rising, the long duration products such as technology, they're the ones that come under pressure. We've done a lot of work on this, folks, so I don't want to bore you to tears. But the basis of our findings was it's crap. It's just absolute crap. There is no correlation that exists between yields rising and growth, NASDAQ, technology coming under pressure as a causation of that. Doesn't exist. We've looked at various charts, various time frames where yields were rising significantly and where maybe new bull markets were starting and where they were plateauing, and none of it works. But that was the narrative. NASDAQ weakness was tied to rising interest rates for many months. US long bond, or the 10-year yield, this latest tick lower for the NASDAQ, has happened, though, even with treasuries flat to down. In fact, treasuries been down all week, right? The 10-year yield has dropped back below 1.60%. Today, I think, hit a low around 1.57%. Every day, the 10-year yield has been down. The NASDAQ has been down now, if it finishes lower today, 5 days in a row, 5 trading days in a row. And here you can basically see NASDAQ is the green and the 10-year yield is the yellow. Don't make fun of me. I can't see colors. I know brightness, and that's the best I can do. But you can see here, they're both going down now. There's no relationship here. The media just kept feeding. They're looking for a reason. They keep feeding this narrative. And if that was the case, then how did the NASDAQ make a new all-time high with yields? Last week, they were above 1.60%, 1.65%. I mean, it doesn't make a lot of sense because there's no justification there. Again, we've done a lot of work on this for our Finom group members. Please go back to the March 14th research report, and you can find all the charts associated with this subject matter. But again, just here's another chart that tells you they're not correlated. There's no causation here. There's just not. This chart right here also I love because we've had rates rise quickly or we've had yields rise quickly. These are every time the 10-year yield has risen over a 30-day period by 35% or more. The forward SPDR or S&P 500 returns have been pretty darn good. 12% over the next 6 months. And it worked again. It worked again. These are some of the bigger ones in green, 40% plus, 45% plus. And here's the Qs, or the NASDAQ 100. Look at this. I mean, what are we talking about here with yields going up and, growth, technology not working? There might be temporary, kind of sentimentally driven price action that seems to correlate. But when it decouples, you get the NASDAQ making up for time, so to speak, which is maybe what happened with the NASDAQ making new all-time highs. This chart right here. So again, 4 days down in a row for the NASDAQ. Today, we also started out in the red, deep red. This chart right here from Chris Shavako shows we have gaps. We have gaps to fill to the downside. We had a lot of gaps created here, in March, coming into April, that are getting filled. Today, this one got filled as we broke this trend line. This was the bottom back in the first week of March. The bottom of the 12% correction, the NASDAQ. Take your trend line. We broke through this today, which is not a good sign. We found some support and reversed. We were actually up at some point here today on Thursday. Then we came into pressure again late in the afternoon. We'll see where we finish today. Still recording during the trading day. But we did fill this gap down to 13,500. We broke below there. I think the lows were around 13.4 and change, which was another gap here, folks. We don't want to lose this trend line support, but we don't make the decisions. The market does. Right now, looks like we're down 73 points, another 0.5%, just above 13,500 on the NASDAQ. Going into power hour. There's another chart of the NASDAQ, and this may prove ultimate support. This chart goes all the way back to 2017, but this was the high here, I want to say September, October of 2018. So you take your trend line there, you can see resistance. We broke through here, retest that support, it held, made new all-time highs on the NASDAQ. Here was that 12% correction, didn't quite get down to that trend line, bounced again, made new all-time highs in here, and now we may find ourselves retesting it around 13,150 to 13,200. So do keep this longer-term trend line in view. I think this is a really good one to hone in on, maybe start to game plan around for you dip buyers, which I fully promote and suggest. We are still, again, think of the macro. Think of the long term. If the thesis is that, as yields are rising, technology's out of favor, we're in a reopening cycle, the greater yield is going to be found in cyclicals and so forth. If that's the worst, reason for not being in the NASDAQ growth and FanMag stocks, that's the worst it can get. I think you want to be buying that worst it can get. If that's the narrative, that's not something to be afraid of. At some point, those areas of the market will become value again based on what they're reporting in earnings and sales growth. All right, looking at this one, are we washed out yet? Have we gotten to that level where we could get a meaningful bounce in the NASDAQ or NASDAQ 100? So this breadth study here is the NASDAQ 100. This is the percent of NASDAQ 100 stocks above their 10-day moving average. And as you can see, when it gets down to about 15 or so, only 15% of stocks trading above their 10-day moving average, we get these really nice reflex rallies. Really nice reflex rally. Really nice reflex rally, so on, so on, so on, so forth. Now, I took this screenshot about 2 days ago. It did actually come down to where the arrow head is now. I would venture to guess, if this doesn't get any better over the next hour, it's actually just got 10 points worse, that we will probably get right to that gray line here and throw off a buy signal of sorts. It doesn't mean it can't go lower. It's just a matter of this is where you at least want to start. You are buying. It is a bull market. Credit spreads are tight. Financial conditions are loose. Yield curve is steep. Earnings are growing. Buy the dip. Technology sector, 20-day lows are expanding. This is another one that says maybe we are. You combine this one with this one. These are starting to say we're getting to washout levels here. How much worse can it really get, especially after those earnings that were just delivered? Do not want to be in this area of the market if you're thinking long term. Do not see the value that's developing in technology, in FanMag, in growth. Percentage of stocks at 20-day lows has rocketed higher here recently. Could it get worse? Yeah, it could get a lot worse. You typically don't stay up here, A, very long, B, unless you are in some type of material bear market. This chart, as you can see here, this was March of 2020. I doubt it's going to get that bad, folks. We tend not to have two bear markets back-to-back years either. Think about that. When was the last time we had a bear market in back-to-back years? 20% drawdown, technical or otherwise. All right, this is a relative performance of the semiconductors. This is a technology subcomponent or industry, if you will. So the SMH, the Semiconductor ETF versus the SPDR, the S&P 500 ETF. And you can see it's come down to the 200-day moving average. I'd venture to guess today it broke through there. Now it can do that. It has done it in the past, back in 2019, before rallying significantly. Then again, rallying. So it's not the end all and be all. It usually stays here, a little bit before the next leg of its uptrend. But based on today in NASDAQ, there it is, SMA. It's actually fighting very well. You got an 80-point decline on the NASDAQ. In tech, you're down. But that's holding up pretty well. That may be the first to go. That may be the first signal that says this is getting to those washout levels in the growth areas of the market. That we do have semiconductors holding up pretty darn well in a pretty bad tape. Only up 6 points there in the S&P 500. All right, let's move on. This is growth versus value, or value versus growth. The value ETF versus the growth ETF here. And as you can see, this is what you would assume. The value is on a new leg, right? Because this leg down was when, here from March through April, where we saw growth outperform value. But now we have value outperforming growth again. And we broke above this short-term trend line here. There's two different ways to look at this. You could say, well, it broke the trend line, it should go higher. That's a bullish pattern. Or you could say, doesn't that also mean it could be overextended, due for a check back? Can go either way. It could also be more than a check back where growth comes back to life yet again. The thing about charts is they don't tell the future. They tell you what has happened in the past and what is developing now. In terms of, trade the chart in front of you, no. That's a garbage colloquialism. I know it's been made famous by a lot of technicians, but you can't trade the chart in front of you. There's no scientific basis for that. We'll get to that in a few minutes. What you need to have is multiple disciplines. You have a technical discipline, you have a fundamental discipline. If you have a macro discipline as well, that's even better. You want to have multiple disciplines. I'm not denigrating technical analysis. I'm just saying, if you think about the phrase, trade the chart in front of you, if you just think about it from a logical perspective, it lacks. It's lacking. I can go into a long-winded story here, but I'm not going to do that. Anyways. And here is something from a New York University study with respect to technical analysis. The main drawback of the technical analysis is that it has no academic or scientific confirmation, and it can't be validated by any rational arguments. Critics of technical analysis compare it to reading tea leaves. There is nothing, they say, about a chart formation that necessarily makes a stock move in a predictable manner. On the other hand, if enough followers believe in the predictive power of the chart, they'll essentially create a self-fulfilling prophecy. In other words, you need volume to go along with that belief. You need many people to believe in your chart pattern recognition. You need many people to align with, and you do have that. That has created over the years its own efficacy when it comes to technical analysis. Fibonacci's, all kinds of different, technical perspectives and analysis. Here's the analog that we've been following, the newer analog with respect to the NASDAQ. This is the 1998 to 2000 NASDAQ analog laid over with 2020 through present day. And as you can see, this is where we are right now, and it seems like we are getting off the beaten path. What I tend to say is we're on the same path, but from time to time we can travel along a different plane. We did so here in 1998 to the 2000. That particular analog took a dive here, but we continued to rally. The arrows point with every deviation, but we're still on the path. So right here we have another deviation. We're still on the path. In fact, we took the elevator. Right now we're kind of stalled out. Maybe too many kids are pressing the elevator button. We're not going anywhere. But we'll see. We'll see how this analog plays out with time to come. Margin debt. Quick study on margin debt. So I've seen this just plastered by Calum Thomas. He's a very popular FinTwit financial Twitter account, and he posted this over the weekend. S&P 500 index versus the margin debt. Here's the S&P 500. Here's margin debt, right? And it's basically back to levels that we saw in 99, 2000, right? Anytime you mirror something to that phase, and it's not the NASDAQ, people get scared. People worry. This is ludicrous. Oh my gosh, it's the end of the world. The market's going to plunge like it did in 99, 2000, and like it did here in 07, 08. This is wrong. First of all, why are we just looking at S&P 500 margin debt? Why are we segmenting one index? This is the best way to look at margin debt. This is total U.S. margin debt as viewed through the U.S. Wilshire 5,000 market cap. This is basically all stock market. It's the entirety of the stock market. And as you can see, margin debt is only right there. Is it elevated? Yes. We've been in a year-long uptrend now, more than a year now. We have greater retail participation. We have more platforms for people to trade. We're going to get more margin debt. This is nowhere near where it was here in 2008, 2009, nowhere near where it was during the dot-com period. Here's another way to look at it. All right, fine. You want to just look at S&P 500 margin debt? Let's just look at S&P 500 margin debt. This was something that I tweeted back at Calum Thomas and Michael Kantrovitz of Cornerstone Macro Research. And I said, all right, let's use your chart. Note the delta between the S&P 500 and margin debt in prior margin debt peaks, 2007 and 2000. So what we see here back then, you have a delta here. You got this big gap. The S&P 500, while margin debt was growing, S&P 500 didn't follow to any significant degree. Here again in 07, margin debt was just kept climbing. The S&P 500 did not follow to any significant degree. The difference here is we are following. So that's what I tweeted back to the two of those gentlemen then, and wouldn't you know it? Just 18 hours ago, Michael decided, okay, thank you, Seth. I'm gonna use that now, and basically I'll do the circles, create my own chart of basically what you said. I gave him a hand clap and a smiley face. What are you gonna do? I'm just glad he got the message out there. Got 126 likes and 40 retweets. So more people know there is a difference. And by the way, margin debt doesn't cause anything. Margin debt is coincidental with the trend in the market. It has no causation element to it. When the market goes up, margin debt goes up. When the market goes down, margin debt goes down. It's the way it goes. All right. How much is priced in? Grab a drink. How much of the good news is priced in? Everybody wants to know. Quick check in here on market. So we're coming back on the NASDAQ. That sucks. I say that because I'm a buy the dip guy. I want value. You know, I'm okay with the market being down. I'm okay with growth, NASDAQ, getting Apple at cheaper levels. I'm fine with it. I've got a lot of cash on the sidelines. All right. But how much is priced in, right? You saw the jobless claims drop below 500,000 initial jobless claims today. Consumer confidence, like off the charts. The ISM manufacturing numbers are fantastic. They're in the 60s. I mean, you look at the economic retail sales, you look at all this stuff and you're like, and the S&P 500 hasn't even had a 5% closing basis drawdown in 6 months. We haven't had a double-digit drawdown since the bear market. How much is actually priced in? My rule of thumb is when anybody says that XYZ is priced in, like run from that person. Like if they know that, just give me the lottery numbers. If you know what's priced, you can tell the future. Give me the lottery numbers. I promise you I'll buy you a boat. So, nobody knows. Nobody really knows. All we have is data to go on. Based on the current situation, we can look back at the past using maybe some economic metrics and earnings metrics to identify the probable returns going forward. So the first one we'll look at is GDP, right? Now, on an annualized basis, GDP just turned positive. I know we're getting these 6% GDP numbers for Q1, and we'll get revisions to that, but that's quarter over quarter, not year over year. But we are positive, and we see the forecast out there with GDP, forecast of 6 to 10% amongst the economists. So keeping that in mind, let's say we do have a year over year change of 6.1%. Well, historically, returns suck. The returns are pretty woeful. It's usually you have that kind of GDP coming out of a major downturn. And you have had a major run up in the S&P 500. So the returns are pretty abysmal. They're negative. They're negative over the next 12-month period. What if you're between 0.8% and 6.1%? Well, you've got a much better chance at 7.1% annualized gain. When you're at 0.8% and below, gains are really good. That doesn't necessarily mean you just came out of recession. It could mean that the Fed wants to stave off a recession, so they're lowering rates. You lower rates, you know what happens. You've seen it before. Market starts to ratchet higher. So that's one way of kind of looking at it through, a macro lens. What can we expect? Now that's just one. And I know what people, gosh, the forecasts are 6% and above for, this year. I mean, is it going to get this bad? If we look back next May, it could, but we'll see. We've got time in between now and then, keeping in mind that most of our breadth studies and our historic data says this year has a strong potential to deliver double-digit returns. All right, let's look at ISM manufacturing, which has been in the 60s, right? Well, one of the most highly watched economic reports comes out each month, the ISM. As you can see in the first chart above, and this is where we are, folks. Again, we've had this tremendous surge. Somewhat anomalistic in how it's happening. It's happening mainly, at least the majority of it is because previously the service sector was shut down. All of your consumer spending and capital goods spending was on manufactured goods as opposed to services. That will alleviate, going forward. We've already seen a bit of a disappointment in the most recent ISM. Having said that, The first chart, the ISM, has been on a tear well above the 50. It got into the 60s. However, as you can see in the second chart above, this one right here, too much of a good thing has historically been an issue for stocks. Forward 6-month S&P 500 turns by ISM Manufacturing Index decile. And right now, folks, we are in this decile. Again, don't shoot the messenger. But one of the things I fall back to, though, is we've got a ton of fiscal stimulus. It's one thing to get to these levels, right? Because you usually don't stay here. You go back down rather quickly. But with the stimulus that we have in the system, and this does look a lot like 1983, 1980, the end of 82 into 83. And remember what the returns were then. From 1983 to 1985, and then into 1987, we finally had a major correction. From 83 to 87 was spectacular. This could be that same setup, folks. We'll see. Otherwise, we have to be realistic. Keep an eye on those ISM numbers. Consumer confidence. Here's another one. I mentioned earlier, consumer confidence off the charts. You can see how quickly it's come back. The rapidity, the rate of change in consumer confidence related, you can correlate it with the vaccine rollout and vaccinations happening ahead of schedule or achieving the White House administration's goal ahead of schedule. So it's come back rather quickly. Now, when consumer confidence is above 106, 2.6% annualized returns, because usually things are getting kind of frothy and you roll over. But I would, we spent a lot of time over 100, 95 through 99. You never know. Between 68 and 106, 8%. And right now we are at 120 on consumer confidence. 68 and below, you get the most turns, because that's when things got really bad. That's when things got really bad. Recessions are usually around those levels, market bottoms, and you get a really huge bounce back. So we'll see. Now this one is earnings. Look, at the end of the day, it's earnings. We can look at all these studies related to economic data till we're blue in the face. But if earnings are falling, you know what's going to happen. If earnings are rising, the market will catch up. It could go through fits and starts, but over time, the market's going to follow earnings. S&P 500 earnings, year-over-year percent change. When the year-over-year is above 20%, think back to 2018. We had, above 20% because of the new tax policy. So you had a lower corporate tax rate. It artificially elevated the earnings growth, and we had a terrible year. We were down 4.5% on the S&P 500 year, even though earnings were up 20%. It's basically because we had the Fed tightening as well as raising rates. If it wasn't for those variables, who knows? It's an open-ended question. We can't go back and turn back the clock of time, the hands of time. When earnings are between 10% and 20% growth, you have a pretty good year. Between negative 10% and 10% growth, even better. Usually it's because the numbers are getting easier, tends to coincide with an earnings recession, if not an economic recession. Markets find a bottom, and then over the next, because they are forward discounting mechanisms, they're pricing in future earnings growth. Here, how much future earnings growth can you really price in? How much more, how much better can it get from here? That's why we're going through this exercise of how much is already priced in. Now, when earnings are down 25% and below, it's really bad. But when they're down between 25% and 10%, look how good it is. And that's basically where we were last year. We had basically 25% earnings decline last year. When people say the market shouldn't be doing this, look at earnings, you're thinking about right now. The market is not about today. It's a forward discounting mechanism. What is it discounting? Future earnings. I tried to tell this to so many people back then. I'm like, no, stop it. The market doesn't care about today. The market is pricing in tomorrow, next month, 6 months from now, a year from now. And we did this and then some. Now, here's the question. We saw first quarter's earnings, or we're seeing first quarter earnings. We came into the first quarter expecting 25% Q1 year-over-year earnings growth. As of today, Refinitiv is tracking Q1 earnings growth of 50% versus a year ago. Here's my question. Where are we if we get 50% for the year? This is where you got to kind of think abstractly. Abstractly. I promise I speak English. Are we actually right here? Imagine if the earnings trajectory or the earnings estimates for 2021 are supposed to be between 25 and 30% annualized earnings growth, but we actually come in at 50% annualized earnings growth. Weren't the estimates at -25 if you do the subtraction there? Could we possibly get something like this? I think that's the mark people are missing right now in calling for these corrections of 10, 15, 20%. I think people are failing to see what investors are doing as measured by our breadth studies, the percent of stocks trading above this moving average and that moving average. And what we're seeing in the earnings picture right now, folks, people are expecting Q1 earnings to be 25% year over year and full year about 25 to 30%. Q1 is coming in 50% above last year. What if the whole year, because next quarter is supposed to be 60% above last year. We're not done with earnings. It wouldn't surprise me if in the first quarter we're 60% above last year. If we're 60% above for Q2 as well, folks, we could very easily do 50% growth in earnings versus last year. That would put us right here, -25% on the estimate coming into this year. There's a huge delta there. I think the market has seen this. I think the market knows this. I think investors, institutions know this. But the strategists and the analysts that they march out on TV don't speak about this line item right here. They're not thinking about this abstractly. Could I be wrong? I think if I'm going to be wrong in looking at it this way, it's because something else happens in the macro picture that could be Fed related. The Fed may start to taper too early. There could be a fear that the tax legislation is going to be agreed upon and it's going to be, at a level that, well, investors don't want to see it at. I mean, those could come into play. But that's what it would take, in my opinion. That's what it would take. Because this is reality. We don't know what the back half of the year is going to look like so far as earnings when the economy is basically fully reopened. We know what we're getting when we're like 3/4 of the way. And that's been a rolling process through the first quarter. The second quarter, we're going to have a full 3/4 of the economy open. What about this, Q3 and Q4 when, we're forecasted to have the whole economy open? 50% year over year may be light, folks. Keep it in mind. Keep it in mind. So as we're seeing this dip here in the NASDAQ, which may find its way into the S&P 500 at some point, it might. Keep this in mind. When it's time to buy, you probably won't want to. Because you're scared, because, there's blood in the streets, the market is going down fast, volatility is going higher. But that's your signal to buy. When you feel like you can't, when you feel fearful, that's usually the signal to go out and buy. We're probably nearing a bottom. Inflation overheating, again, we're getting that narrative left, right, front, and center. What usually goes unmentioned is that these commodity prices, so we're looking at PPI here, because we're going to get that data next week. Commodity prices and consumer inflation, that's next week. The March reading was at 4.2%. You should anticipate a 6% number, in my opinion. If we don't get it, good, fine, great. But that's a probability because we have the base effect. These next 3 months of PPI and CPI should be the hottest because they were the weakest going back a year ago. So you get that base effect. March, April, May last year is when the entire economy was shut down. Prices fell through the floor. Now we're back up, and what you should see, is a huge rebound. It's that year-over-year impact. There's that delta between, the bottom, the negative numbers, neutral, and positive numbers. That's going to get filled. But what usually goes unmentioned in terms of commodity prices being, widespread, because we know that prices have been ticking higher, is that the producer price index rarely sees the follow through to consumer prices. And that's what this chart signifies here. It's the producer prices over CPI in yellow. And you can see they used to follow each other in the 1970s, in the 1980s. But once we got into the 90s here, you see it just flats. It doesn't matter if producer prices are spiking. Consumer prices are not doing much. Look at these spikes. Consumer prices are not doing much. And we just rolled over into the 2000s and been, flatlining ever since. No matter these spikes, they don't feed through to the consumer. The consumer has a threshold. Consumer will tell you enough's enough. And there's nothing more that you can do about it if you're a producer. But usually it coincides with those prices coming back down. And they will come back down as the service sector opens up more and more. There won't be so much pressure on those manufactured goods and the raw materials to produce those manufactured goods. So keep that in mind. Some studies that we talked about also in our March 14th weekly research report related to the S&P 500 performance alongside these spikes in PPI, because we've seen them before, 6%, 5%, 4%. This was back in 1982 into 83. We know what happened after 82 into 83. The market started to rocket ship higher. Again, here, 2004, 2005. What happened to the S&P 500? It was up in both of those years. Here's another example, and probably the only example where we had producer prices climbing and the market going down, 2000 and 2001. So out of these three examples, when we've hit this threshold of 4.3% or higher, only once do we really see the markets come under pressure. It's a lot of media with little data to support their notions. Speaking of commodity prices, just producer prices, industrial metals fall into this cohort of inflationary fears. But when we look at the actual data, when copper is at an all-time high and the S&P 500, we've seen it happen before, 95, 89, 65, 56, 54. So S&P 500 after stocks and copper are at all-time highs. It's a mixed bag here. Sometimes S&P 500 did crappy 12 months later. Sometimes it did really, really well. This doesn't give us a whole lot to go on if we're just looking at both of those being at all-time highs. I think sometimes it's about where you are year to date. So we'll look at that. S&P 500 after stocks and copper are up at least 7.5% year to date. We know copper's up 20, 30%. And the S&P 500 is up 11%. So if we just, say at least 7.5% on a year to date, it's happened 8 times before. The average return 1 month later is not good. It's down. Percent positive is only 37%, expecting that choppiness near term using this particular criterion. 3 months later, it gets better though. The average return 2%, rest of the year 7.5%. For stocks, for copper, down, down. Percent positive, standard deviation. You're down almost entirely 1 month later, 3 months later, rest of the year, and you're down double digits the rest of the year. Commodity prices, again, can only go so high. At some point, consumer and producers say no more. They can't stomach it. So maybe you shorten copper here. Stocks and copper up at least 7.5% year to date. These are the years that it's happened. It's a good sample size at 8. It's happened in the modern era, 98, 2012, 2021. And again, 1 month return when it happens. 3 months, rest of the year. Buy the dip, folks. Latest notes, I'll let you guys read this when you have time, from Morgan Stanley and JP Morgan, talking about just buy the dip. And I think they're resolving this recommendation based on everything we've covered here. I think if there was one major takeaway that I would conclude with, it would probably be earnings, because it's the mother's milk of markets. It all comes back to earnings at some point in time. And earnings are telling you we're growing substantially more than estimates. If the Fed tapers this year at the end of the year, first they got to change their message. If there is the belief by the end of the year that taxes are going to rise, that doesn't throw any monkey wrench into the S&P 500 long term. It can, produce a spasm. Both of those events could produce a spasm, but that's why you have cash on the sidelines. That's the spasm that you want to buy. We're moving from an early stage cycle into, a mid cycle where quality is going to come back in favor. It's just a matter of when. These constant rotations in the market where growth is in favor, then value's in favor, then growth's out of favor, and back and forth and back and forth. The way I try to, rationalize that is I'm okay with investors moving money around in the market. It's when they move money out of the market that you start to worry. With that being said, again, this is Finom Group. I'm Seth Golden. I hope everybody has a fantastic trading week. See you next time.